Hello everybody. So today a quick video as I'm busy this weekend, but the question that I asked today is, do I invest in two baggers? And this is a quick story. I've been investing for a long time. I mean, what seems like a long time, well over 10 years. And in the early days, if you invest, you're going to be a saver. And if you're a saver, you're going to be a little bit cheap. And if you're cheap, there are stocks you're going to see and you're going to be like, wow, they're cheap. I got to buy these stocks. And so I used to buy these stocks that I now call jokingly a two-bagger. So what is a two-bagger? A two-bagger or two baggers are stocks that are just super cheap. And they may go back to normal, right? If they trade back to their historical multiple, that stock will be a 2x. That's oftentimes what you see in a stock that doesn't have much intrinsic growth. There's not a lot going for them in terms of growth. They're mature companies that the market has just discounted because the market has moved to something else. And you're like, well, if it goes back to normal, this will be a 2x. And I must admit, two baggers still tempt me, right? That's why I covered PayPal. I covered PayPal twice on the channel already. They tempt me, but I try to avoid them. Because I know that a 2x is not what I'm aiming for. A 2x is not enough, right? Especially if it takes you 5 years to get a 2x, you had 15% a year return. You didn't beat the denominator, right? You matched monetary inflation. So, and that's provided you get a 2x in 5 years, right? So sometimes we are much quicker if you get a 2x in 2 or 3 years. That's good, but there's still problems. I'll get into those problems. So I would put a stock like Alibaba or a stock like PayPal in these category of two baggers. I consider them two baggers right now. Also, I'm not going to cover this today, but the TLT, the bond ETF, I would consider that a two bagger too. There's the same rationale. If rates drop and go back to normal, TLT should double. That's like the basic rationale that some people take when they look at these companies, and a 2x may be enough. I mean, if you're a retiree. But to me, that's just not too compelling, and I'll show you why at the end. There's a full reason why at the end. But let's go ahead. Let's look at Alibaba. So Alibaba, so you see it's done nothing for 1 year. But if you go over a 5-year chart, you can see this was a stock that was, handsomely trading between a 150 and 250 range, right? So if it gets back to 150, that's going to be a 2x. Here's the problem with Alibaba: going to growth. Alibaba is predicted to grow less than 5%, right? 4.58% is predicted to grow. Monetary inflation is at 15. Money supply is growing at 15%. As I always say on this channel, this is 4.58, right? You're only investing in a stock like Alibaba if you believe in multiple expansion back to normal, back to the way it used to be. But it's tough to justify buying this stock over when it's cheap. And when I look at the growth, so this is the revenue of Alibaba trailing 12 months, since when? Since 2015. So you can see, buying it in 2015, I could have seen it was great, but the stock has been flat. The revenues have been flat. So on a price to sales basis, this company is just going to trade with the whims of the market, with the sentiment of the market, but it's not going to trade on the idea that if the price to sales remains the same, but the company doubles sales, then the stock price should double. That's not going to use this logic. And so I think it's a stock that is stagnant, right? It's a steady Eddie stock, type of stock you would get if you're a retiree, or if you're already wealthy and you don't like to see too much volatility in your wealth. Yeah, that's a stock that I could see, But to me, for 2x, buying a stock whose revenues have shown this much flatness over the past 8-9 quarters for just a 2x, I don't think the potential pays enough. And when I compare this to, say, a company like Mercado Libre, look at how stellar the growth is for Mercado Libre, right? At Mercado Libre, you're still growing well into the 30%. The growth has been stellar. So this is trailing 12-month Mercado Libre. You can see service adoption for the platform of Mercado Libre is just going up and up and up and up. Alibaba, if you use revenue as a proxy for adoption, Alibaba is flat. It's been adopted. That's it. In fact, if you follow this revenue, you can chart the S curve, the adoption S curve. You can very much chart it. Alibaba is a mature company, so that's why I'm staying away. As much as I love the valuation, and believe me, I love the valuation of Alibaba. It's a cheap stock. Here's another stock that I've covered on the channel that I find dirt cheap is PayPal. PayPal is the same story. If PayPal were to get back to where it was, well, maybe not at the peak, but let's say it were to just get back where it was in 2020, that's a 2x. If it goes back to where it was in 2019, 2020, that's a 2x, right? How long is it going to take to do that 2x? Is it going to be 1 year, 2 years, 3 years? If it's more than 3 years, you didn't beat the denominator. You didn't do that. If I look at growth at PayPal, the growth is also disappointing, 8%. Monetary inflation is at 15%. So buying a stock like PayPal, in my view, is betting for multiple normalization. You're hoping that the multiple will get normalized. And when I look at the revenue of PayPal, is the same story. We can see the S clearly. We can see at the beginning it keeps growing, and then ever since 2021, we've had a little flatness, right? With growth, revenue growth consistently under 10%, right? Early 2021, 7%, then 9%, then okay, one quarter we had almost 11%, but otherwise the quarter after was 6%, and then 8%, and then 7%. So this is not beating monetary inflation. This is not beating the denominator. That's why, as much as I love the stock, I want to stay away from this stock, especially when I compare this to a company like StoneCo. If you look at the growth of StoneCo, right, 27%, 31%, 52%. 70%, right? So a little bit of deceleration, but if you follow StoneCo closely, you may know that growth is actually going to print higher going forward, which is what I look forward to. So a stock like StoneCo is growing much faster than a company like PayPal, like literally 3 to 4 times faster. And so I don't have to count on multiple normalization to make a return on a company like StoneCo. I have to hope, and I only have multiple normalization as my hope to make the return on PayPal, right? Because betting on an actual revenue turnaround is, turnarounds are rare. They're not that easy, right? Turnarounds are not that easy for CEOs, right? So it's mostly a bet on multiple expansion or multiple normalization. That's what this is. This is why I call these stocks two baggers, and by the way, it's more generous than a lot of people would call them. A lot of growth investor would actually not even recognize the merits of these stocks. Like, I recognize the merit. I'm tempted, but a two bagger, to me, it just doesn't do it. Because once they go back to their normal valuation, like let's assume PayPal or Alibaba goes back to trading to normal valuations, then what do? Do you keep a stock that only has 5% of revenue growth or even 10%? You just keep that stock for 10 years? You likely would not. You likely would sell the stock, but if you sell the stock, then you have to pay capital gains tax. And you may say, oh, paying tax is fine. Paying tax is not the problem. Paying tax is not the problem. The problem is paying tax too early, because you're not compounding tax-free, right? If you sell an investment 15 years later, you've had 15 years of compounding tax-free, right? If you have to do 7 or 8 round trips to get the same return with 7 or 8, well, we'll go faster than that, but let's call it a handful of two baggers back to back. Every time you sell the two bagger, every time you hop from one two bagger to another, you have to pay taxes. That hurts for compounding, right? It hurts your compounding. The value of owning a premium stock for a very long time, and the value of owning that stock for a long time, is the fact that you're compounding tax-free and only paying taxes 15 years later, 20 years later when you sell the stock, provided that you even want to sell the stock. You may want to do it like most deca-millionaires do it, most billionaires do it, which is just borrow against your stock, right? That's another way to do it, and then you don't have to worry too much about that, right? You leave that problem to your heirs and to your estate planning. That's another thing that you can do, but I don't like the idea of having so many tax events, right? So this is the last point. The last point is two baggers, right? A PayPal or an Alibaba. Right, Chinese stocks are pretty risky. That can happen to Alibaba. Alibaba, you may have a ban. You may have something going on. They may get delisted from the US. You may be forced to sell it. There's so many things that could happen. Two baggers, just like any 10 bagger, can go to zero. Two baggers, just like any 10 bagger, can go to zero. Right? Silicon Valley Bank, on that Wednesday of March, did anybody think Silicon Valley Bank, a $50 billion company, did anybody think they were going to go bankrupt? They were bankrupt on Friday. Any stock can go to zero. The downside of a company is always 100%. But the upside is not the same. When I look at a company like Alibaba growing at 4%, the upside is 100%. It's a two-bagger. If I look at a company like a StoneCo, the upside is 1,000%, 900%. It's 10-bagger. It's a potential 10-bagger, right? If you hold it for 10 years and the revenue growth keeps going at the pace it's going. So 10-baggers have greater upside asymmetries, I'm going to call it, compared to a two-bagger, in my view. So that's the reason why I try to remind myself often to not buy two-baggers. I'm not into a stock for a two-bagger. I'm into a stock for a 10x, for a 10-bagger. And, it's not a matter of time. You can wait 10, 15 years. I don't have a problem waiting 10 or 15 years. That's also the big issue with two-baggers, is that to make those type of investments make sense, you have to somewhat be in a hurry. Because like I said, if a two-bagger only goes back to normal in 5 years, that's only 15% a year return. And if you're interested in 15% a year return, then why even dabble in individual stocks? You can just buy the NASDAQ and never ever look at it again. And the NASDAQ, I believe, will continue to do roughly about 15% a year. So anyways, that was it for today's video, short video. Thanks for watching. This is not investment advice. If you like these videos, please subscribe to the channel. I really appreciate it. Have a wonderful day.